Hello, welcome to Born Investor. Today we are going to talk about the different types of investors in stock market. There are two types of investors in the stock market. The first one is the retail investor and the second one is the institutional investor. Retail investors are non-professional investors like you and me who invest individually in stock market through a broker or a firm. They buy and sell securities on their own personal account and often trade in small number of securities. They generally don't have any influence on the price actions of stock market. On the other hand, institutional investors are companies or institutions like mutual funds and insurance companies that invest money on behalf of other people. They have a greater influence on the price action as compared to retail investors. They often buy substantial block securities and are therefore called the whales in Wall Street. Further, institutional investors can be divided into two subcategories. The first one is of the FIIs or the foreign institutional investors, and the second one is of the DIIs or the domestic institutional investors. FIIs are institutions that are allowed to invest in foreign countries. The FIIs buys and sells securities on behalf of another body which is based in another country. The investments made by FIIs are referred to as hot money since they represent substantial sums that can be withdrawn at any time, leading to large volatility in foreign markets. Example JP Morgan. DIIs are institutions that invest in the country they are residing in. Like FIIs, they also lead to volatility in the market. DIIs generally include mutual funds, AMCs, etc. Example LIC. Now, as we have the knowledge of both retail investors and institutional investors, we must understand that retail investors should keep an eye on the DIIs and FIIs to keep a track on where all the smart money is moving so that they know the direction in which the market is pursuing.